Welcome to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Stewart, how are you today?
I'm doing amazing. How are you doing?
I'm fantastic. Thank you so much for asking. Judd, how are you?
Better than I've ever been.
Good. That's a great answer. I love that. Better than I've ever been.
Well, you know, Stewart and I have always spent a lot of time in the offices together, but as things have grown and expanded, he spends 2 days in Scottsdale, 2 days in Tempe, so it's been much, much better these days.
With me out of the office.
Oh, there's always so much love between the two of you.
He is the personality. He's got enough personality for both of us. So.
But he's been working on this joke all week, so landed all right. Did all right.
I can't believe a week has gone by already. This was a really fast week. And let me ask you just right out of the gate, the markets. Stewart, what's going on with the markets right now? How are we looking?
Well, we're just seeing some incredible volatility, of course. You know, I mean, I think most people realize that we're, at one of the highest peaks in market history, plus or minus a few percentage points. And, I think most people also realize we're closer to the end than we are to the beginning of this bull run. And so I think it's really important to make sure that you understand the risks that you're taking. And just remember, it's not for me to define what your comfort level with risk is. It's up to you. And so I think it's really important that you talk to your advisor about what kind of risks you're taking and are you comfortable with it. Cynthia, I see a lot of times clients will come in and they have no idea what kind of risk they're taking. And so when they come in and they do our complimentary portfolio review, the first question I always ask them is, how much are you comfortable losing if 2000 or 2008 happen again, right? If we see these market corrections and if they have a $500,000 portfolio, we'll say, are you comfortable if it loses 25 grand? I don't know. Yeah, I think so. That's fine. How about 50? No. How about 60? Definitely not. No. And so everybody has a pain threshold. And it's not for me to define where that pain threshold is.
Sure.
It's for the client to tell me what their comfort level is. And the reason, generally, the more comfortable you are with risk, the less likely it is that you're going to jump out at the wrong time. Because what we see in these down markets with standard portfolios is that people they never got back invested after 2008. So a lot of people that saw a 50% loss never re-entered because they were so scared, and they missed the best market in history. Other people who have done really well are realizing, hey, it's that old Kenny Rogers song. You got to know when to hold them and know when to fold them, right?
Yeah.
Sometimes you got to take some chips off the table.
Yep.
I always talk about this story about gambling for the first time, playing craps for the first time. I remember I was at Sam's Town in Las Vegas having an amazing time with some amazing people. And actually, the original owner of our company, I was there with Paul Mumford, and he was teaching me how to play craps. And I just remember I went out there, I pulled $1,000 out, and this was 15 years ago, 20 years ago, and my $1,000 turned into $10,000, and it was this amazing run. I literally thought I was a genius, and we were out there doing the normal Vegas things, having a great time, and I remember being goofy at the table, unlike how I am on the show. And I say, I was a little obnoxious, but saying, hey, this isn't going to be Sam's Town, this is going to be Stewart's Town by the end of the night, because my money grew. And I think that's the same comfort that we're seeing people within the market now. They think they're geniuses because the market's quadrupled over the last decade.
Yeah.
And you know what? By the end of the night, I'm reaching back into my pocket, adding more money to the table because I was goofy enough not to take those chips off the table and go enjoy it.
Yeah.
I think that's the same situation we're seeing right now where, people are saying, a lot of people have already won the game. So why are you taking additional risk? Sometimes it's worth understanding what those risks are and maybe taking some chips off the table.
This is only why I play bingo. It's enough gambling for me.
Well, and you know, Cynthia, on top of that, what Stewart's talking about there again is market risk for a lot of people. But the other pieces are, what about inflationary risk? Are your investments going to keep up with? So if you go conservative, are they going to keep up with rising inflation? Or what about a traditional portfolio that shifts into bonds when you're trying to look for safety when the stock market's struggling, but then rising interest rates? So you've got that interest rate sensitivity. And then what we always tend to talk about is that tax erosion. You know, making that extra percentage point or 2 percentage points this year may end up costing you more in taxes. So why take the extra risk if you're going to give it away on the tax side of it? So there's a lot more things to think about than just the actual market risk.
Sure, and that makes sense. Stewart, I have to ask you, are you seeing a lot of people that are becoming more conservative as they get up in age, limiting their exposure to the stock market, if you will?
Well, I think what we're seeing is that people realize that that's kind of the right move in most situations. But what conservative is to some people is different than what it is to us. So like Judd alluded to, historically, conservative means just shifting from stocks to bonds, right? Like you'll see these target date funds that were designed in a lowering interest rate environment. Because remember, for 35 years, interest rates have dropped. Well, now we're seeing the peak, where they're starting to peak up and climb exponentially. And the problem with that is if you buy a bond that's paying 2% today, and next year they're offering the same bond at 3 or 4%, well, who's going to buy your bond? Well, someone will buy it, but they're not going to give you full price for it. And that's when you start losing value in bonds. And so some of the potential risk out there with bonds is that they'll be worth less money next year compared to what they're worth today. And so, does the 2% yield on your bond make sense to have? Well, there's a lot of other strategies out there to offset that sort of fixed asset world, and I think it's really important to not be in love or to hate any specific investment. It's to be open-minded to what's available out there and to be available or open-minded at least to all your options.
Judd, did you have something to add? I think you were wanting to say something as Stewart was finishing there. I could see the wheels turning.
Well, I mean, again, I think it's that you have a shift out there. So some of it is old-fashioned, where we say, stocks and bonds. The other piece is, 20 years ago, 30 years ago, if you had a bond portfolio, you actually owned the bonds yourself. So the one protection you had was that if interest rates were to rise, as long as you hold on to that bond till maturity, you're going to get those funds back. But anymore, when people own bonds, they own them inside a fund of funds. So they don't actually have that certificate, so they've now given up one of the few safety features that would be involved in a bond investment. So some of it's changing times, and some of it is, again, changing perspective.
Absolutely. Stewart, you have a very special offer to the viewing audience at home. Do you want to talk a little bit about that before we take our very first commercial break? Absolutely.
So what we're offering our audience today is for the first 10 callers, if you just give us a call at 833-652-7829, what we'll do is offer you a complimentary portfolio review. And what we'll do is we'll take a look at what kind of risks you're taking inside your portfolio, what kind of fees that you may have in there that are hidden. If you have some very expensive annuities and variable annuities, we can take a look at the fees there and the expenses there. We'll also take a look at any sort of tax implications that may be hiding in the background there. So just give us a call at 833-652-7829. We'd be glad to give you a second opinion.
Stewart, thank you so much. Judd, thank you so much. To the viewers at home, the phone lines are now open. That number to call is 833-652-7829. Again, as Stewart mentioned, it never hurts to get a second opinion from a fresh set of eyes. If you're not currently on the right path for retirement, wouldn't you want to know today? Again, all you have to do is pick up the phone and call 833-652-7829. We'll be right back after this very short commercial break.
Happens oftentimes is we'll run into clients or potential clients that have saved all this money, but they're 75, 80 years old. They've got this big pile of money, but they're not enjoying retirement because they're so worried about running out of money that they never actually get to enjoy their life's work. And so to me, it's really rewarding to be able to create a plan so that these people can have a great time in retirement, knowing that they're not going to run out, that they're going to be fine. I think it brings a smile to their face.
we get a lot of different people at a lot of different stages in their lives. And what we're able to do is, for some folks, it's able to tell them that you're on track. Keep doing what you're doing, and 15 years from now, you'll be retired and enjoying life the way you want it to be. For some people, it's people coming in and they're 3 to 5 years away from retirement, and you're able to tell them that, 5 years, 3 years, tomorrow, you're ready to go.
We are a complete shop. We handle estate planning, taxes, financial planning. We do a really in-depth cash flow analysis that is way more detailed than you'll see in the market.
Everything all in one spot, with the left hand always knowing what the right hand's doing. Because it's not just about the investments, but how's that going to affect your taxes? It's not where are you going to be 5 years from now, 15 years from now. And it's that back and forth full view of what the clients, not only today, but tomorrow and their legacy down the road is going to be, that really sets us apart.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. Gentlemen, a great show that we're having today, talking about such important topics. But Judd, I have to ask you a question. What specifically makes your company different from a lot of the other advisors that might be out there?
Well, I think we always try and reiterate this, but sometimes until you actually come in and experience it, that makes it tough. But it comes from where we've grown from. Our business has adapted over the last 24 years, and not because it was the things that Stewart and I thought we should have or do. It was because those were the needs that our clients had. So to be able to handle the estate planning, the taxes, the tax planning, handling the investments from the fiduciary side, all those things have grown over that time. And on top of that, we give you the ability to have a one-stop shop where we're going to do the holistic planning, look at the full picture, make sure you know how your required minimum distributions are going to affect your taxes 10 years from now. If you should be doing Roth conversions, and if you did, what amount should you do, and how's that going to take care of you in retirement or increase what goes to your children or through your legacy planning. But again, it's not just one product, one size fits all kind of scenario. It's individual planning. It's looking at your scenario. It's finding that best fit. And for a lot of the people that come in, if this is your first time watching it, we'd love to hear from you and get a chance to sit down with you and show you the things that we can do. If you're someone who's caught the show a few times, because we tend to hear that, people will catch it a few different weeks and then decide, you know what, I'm going to call in and see what's going on. And again, the other piece that's different about us is you're going to sit with Stewart or I. You're going to sit with one of the two owners of the business. This isn't someone that spends a lot of money advertising and you hear their name but you never see them. You sit with an associate or a sub-advisor. You're always going to be working with one of the two owners as you sit down with us.
I love that. I know, because people enjoy coming in. They love meeting the two of you. And we've always heard that you give them individualized attention. They feel like there's nothing else going on in the world and that you're spending time listening to what their needs are. That's a huge testimonial to you both. Stewart, I want to ask you a little bit, if we could just jump back into portfolio risk a little bit. Could we talk about that just a little bit more?
Yeah, absolutely. I think when it comes to portfolio risk, I think there's an additional risk out there that a lot of firms succumb to. And one of those risks are just being overly concentrated in their perspective. And so I've been very focused on this concept here over the last few months because, listen, we're all human beings. We all see the world through our lens, right? And, we're in Arizona here. We're a very divided state politically. And, just going into the elections, people, I happen to be kind of center-right here. I'm a Berkeley-educated, moderate Republican, so I'm a little confused apparently. But, but no, I try to be as reasonable as possible, right? And we see crazies on the right, crazies on the left. And going into the elections, a lot of people on the right really thought, oh my gosh, if Biden wins, the market's going to crash. And, I may have thought that as well. But at the end of the day, it didn't. And so what that's really got me to think about was that our process of not just having a single money manager is really the best thing. A lot of times at some of the local advisors, you've got the guy that's sitting behind the desk that's saying, hey, I like this mutual fund. I think this one here, this combination makes sense for you. And, there's even a big money manager that says, hey, we're tailoring our specific portfolio just to you. And they pick 500 different stocks they're buying for you. The problem with that is, regardless of how many positions you have, your portfolio is being reflected through the perception or the perspective of a single person. And listen, I jokingly say, and it's a little obnoxious, listen, I went to one of the best public schools in the world, and I think I'm a pretty smart guy. But when I got there, I realized I wasn't as smart as I thought I was, right? And in that humility there, which Judd thought I would never say I had, is actually, I think, what helps our clients, right? So I think that sometimes these advisors, these money managers, really are playing with your money in a way that, they're taking, a lot of risk, this hubris, this excess, lack of humility could really get you in trouble, because here's the thing. We had multiple money managers going into the election. One of them kind of bet, that, hey, the market was going to correct if either one of them won. One of our other money managers, who's one of the biggest, actually the biggest money manager in the world, they basically took the position of, no, we're going to hit the gas going into this. And they were right? The other guy was wrong. The other one was right. But here's the thing. Is don't have all your eggs in one basket. Yeah. By all your eggs in one basket, I don't mean just your money with one, advisor. I mean, don't have your money with just one money manager. And so within our company, you can diversify between different perspectives, all here at one place.
Absolutely. Judd, can we talk a little bit about inflation risk?
Yeah, I mean, again, that kind of comes back to some people when they're looking at, the number one concern is, am I going to run out of money in retirement? The biggest two pieces I think that we see with that is someone will either underestimate what they spend, kind of like my wife and kids tend to stop at Starbucks. And if you ask them, they spend about $10 a week. But if you actually look at what they spend, it's about $50 a week. So the idea is you want to make sure that they know what they're really going to spend. And then you have to account for inflation, because even though we've had some substantial drops in gas from a few years ago, and now it's coming back up, but gas costs more today than it did 20 years ago.
Sure.
Eggs and milk cost more today than it did 20 years ago. So people have to realize that there's certain things you're going to use, and that money is going to have to come from somewhere, and you're probably not going to get that from Social Security. They like to give you a nice little cost of living adjustment each year, but typically that pays the additional amount that goes to your Part B of your Medicare. So that evaporates the moment they give it to you. And then on top of that, I mean, you just really want to know that you're going to be okay. You don't want to have to cut back when you're in your golden years. You don't want to have to cut back on, health or medical or any of those kind of things, those needs versus wants, just because you didn't account for inflation.
Thank you so much, Judd. Stewart, you have a special offer to the viewers at home today. Do you want to talk a little bit about what that is before we take the phone calls?
Absolutely. So what we're offering our audience today is to take a look at what kind of risks they're taking inside their portfolio and in their situation. So if you pick up the phone and call 833-652-7829, what we're offering you today is a complimentary portfolio review. And in that review, once again, we're going to take a look at all the fees that you're paying. We're going to tell you the kind of risks that you're taking. And we're going to tell you whether we believe it makes sense or not to take some of those chips off the table, to diversify some of that risk. And, what does your diversification look like? Because a lot of times people think they're diversified and they're really not. Sometimes when you have that single perspective I talked about, it's very concentrated, that risk. So give us a call at 833-652-7829, and we'd be glad to take a look and give you a second opinion.
Stewart, thank you so much. Judd, thank you so much. To the viewers at home, the phone lines are once again now open. That number to call is 833-652-7829. Again, it never hurts to have a second opinion from a fresh set of eyes. All you have to do today is pick up the phone and call 833-652-7829. We have to take a very short commercial break, but don't go anywhere. When we come back, we're going to have so much more about how to plan your perfect retirement. Please stay tuned.
This is the story of how you get from here to there. Right now you're here, but in the future, you want to be there. And from here, there looks pretty good. But so few get to there. Why? Well, of those who do make it, some will have luck, but most will have a strategy. They will save and invest, grow and protect, and they will work with advisors who will help guide their way. If you're looking to get somewhere, to get there, we know how to set a course. It's what we do, and we do it well. We're investment specialists, retirement advisors, insurance experts, and financial planners. We have innovative wealth tracking tools to monitor your progress every step of the way. Wherever you are now, we can help you get to where you want to be. The road between here to there is shorter for those who know the way.
And welcome back to the Asset Preservation Hour. My name is Cynthia DeFazio. I'm joined today by Stewart Willis and Judd Carlson. They're the co-founders of Asset Preservation Tax and Retirement Services. I love this part of the show, gentlemen. I know you have no idea what's coming next, but we have viewer questions.
Uh-oh.
So, Judd, can I throw one at you?
Absolutely.
All right, this is a great one. This is from Maggie. Maggie said she is turning 72 in November. When will I be required to make my first RMD, and can I avoid taking the initial withdrawal and the second withdrawal in the same year?
Oh, well, that is a great question, very common question. But before I answer that, I did want to take a moment. One, I want to thank all of our longtime clients who tend to tune in each and every week. Apparently, they don't get enough of us at the office. So thank you to all of you for continuing to watch. And I'd like to thank some of our newest clients who also continue to watch and make sure they let us know when we have reruns out there. The second piece is, Stewart obviously told you a little bit about himself there, and that he went to one of the best public universities in the nation. I was originally born in Iowa, born and raised, came out here, went to high school in Arizona, and I went to the best public university in the state of Arizona, Arizona State. Go Sun Devils.
Yay, yay.
And that's about all I got on that topic. I just had to make sure I got that piece in. So,
I love that.
So back to Maggie's question. So typically the way it works when you have to take your RMD, the new age is 72, so you're required to take that RMD. She can take it in this year when she turns 72.
Okay.
Or she would have the ability to take it next year before April 15th. But to her point, if she took it next year, counting for this year, it would be taxed next year, as well as she would be required to take a required minimum distribution next year in the year that she's 73.
Okay.
So typically, unless she's just retired this year or is going to be in a higher tax bracket in our current tax year, it would make sense to go ahead and take it this year and then take the separate one next year rather than taking them both in that same year.
All right, that sounds great, Judd. Thank you so much. Stewart, I have a viewer question for you. Are you ready?
Uh-oh.
All right. This is a great caller. Name is Lisa. She said, I was advised to roll my 401k plan from a previous employer into a traditional IRA, which I did. I haven't made any contributions to it since rolling it over, and it's grown very little. I have a 401k with my new employer. Should I roll my traditional IRA into my new 401k account?
Well, typically, there may be some hesitancy or some resistance to your ability to actually roll it back in from the IRA. But whether or not you should roll your money out from a 401k to an IRA all depends on your situation. I mean, there are some ERISA protections, which are some laws that protect you inside the 401k differently than the IRA. There's also some loan provisions that are really important. What I would say is, I've seen really good 401ks and really bad 401ks. I've seen some really good IRAs and some really bad IRAs. We're looking at managing a pretty large company's, a local company's 401k plan. And what I've found in 401ks is that there are some really good options out there. And quite honestly, it all depends on the employers, how they're trying to manage their expenses. sometimes there are loaded mutual funds inside some of these 401k plans, which makes no sense at all. So in answer to her, I would say it all depends. It depends on, I would say, give us us a call. Call us at the number at 833-652-7829. Give us a call. We'll take a look at your specific situation, because what I've always told people is that it's not one size fits all. In your situation, it may make sense to stay there. It's like deciding on whether or not you take your lump sum pension distribution. In your situation, it may be different from your friend down the hall. So don't just depend on their advice. I always tell people, let's cut out the water cooler talk and go talk to a professional. And if you want that to be us, we'd be glad to give you a second opinion on what you should do. But, I would just say, in short, it all depends, which is not a great answer. I don't know.
Because it's not cookie cutter. It's all individualized. This is a great question, Judd. It says, can I buy ETFs for my Roth IRA? The caller's name is Jane. Can I buy ETFs for my Roth IRA?
Well, you certainly can, Jane. Obviously, some of that's going to depend on the custodian, where you have that account held, and what they allow you to invest in from there. But in the end, the Roth terminology is really just the IRS wrapper that lets you know that the money that's in that account has already been taxed, and that future growth will be tax-free as long as you've met your certain provisions, you've been in it for 5 years, etc. But yeah, typically the idea would be, yes, you should be able to purchase ETFs inside that Roth, and if you can't, obviously you could come in and see us. We can certainly make sure that you can buy some ETFs inside that Roth under our watchful eye.
Both of the major custodians we deal with both allow us to buy ETFs. In fact, a lot of our portfolios are ETF-based, which is exchange-traded fund. It's a very low-cost version of a mutual fund. There's some liquidity differences and so forth, but we use both TD Ameritrade, who's in the middle of a merger with Charles Schwab, and we use Fidelity as our custodian. So we have access to both. I think that's part of that diversification that people like as well. So our custodians are very ETF friendly.
Thank you so much, Stewart. Judd, we have only a little over a minute left of the show this week. Do you want to tell the viewers one more time what they can expect to receive by calling in?
I would love to. So if you're out there and you want to call 833-652-7829, we're offering a complimentary portfolio review. Come in, spend an hour or so with us. Let Stewart and I sit down with you at the office, look at what you've got in there, what your risks are, what your tax implications are, any other questions you have regarding estate planning, Social Security, everything that comes together to build that perfect retirement plan. 833-652-7829, and we look forward to seeing you at the office.
Gentlemen, I can't believe another week has gone by and we are together now. Another show is done. I look forward to seeing you both next week. To the viewers at home, most importantly, thank you for spending time with us again this week. That number to call is 833-652-7829. Any questions about how to retire with confidence, retire comfortably, please don't miss the opportunity to call 833-652-7829. Be safe, be happy, be blessed. We'll see you back next week. Thanks for watching.